Hi everyone, this is Knowledge Topper, and in this video we will discuss about another most important financial ratio, and that is debt to equity ratio. We are basically covering the series of financial ratios, so this is one of the videos of our financial ratios series. We will understand this with the help of an example as always we do, so more importantly your concept should be clear. You can watch all other financial ratios videos by clicking the link in the description of this video. But before moving towards the main, if you didn't subscribe to our channel Knowledge Topper yet, please do subscribe to our channel Knowledge Topper as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So first of all, we will look at what debt to equity ratio is in general. Then we will further discuss more about debt to equity ratio in detail, and at the end of this video we will solve an example as well. So more importantly your concept should be clear. Okay. So, as written on your screen, the debt to equity ratio is a financial liquidity ratio that compares a company's total debt to total equity. The debt to equity ratio shows the percentage of company financing that comes from creditors and investors. Like basically, in simplest of words, you can say that the debt to equity ratio is a comparison of a company's total debt to total equity. Okay. Like suppose if a company has a higher debt to equity ratio, it basically indicates that more credit financing like bank loans is used by company than as compared to investor financing, or you can say equity financing or shareholder financing. Okay. Now we will see the formula. So here is the formula. So basically the debt to equity ratio is calculated by dividing total liabilities by total equity. Okay. Like the debt to equity ratio is also considered as a balance sheet ratio as well, because you know that like all of these elements like total liabilities and total equity belongs to balance sheet items. Okay, so this ratio is also considered as a balance sheet ratio because all of the elements that are reported on the balance sheet. Okay. Now we will quickly jump to our example that I prepared for you guys to more clear our understanding about debt to equity ratio. So here is the example. Assume a company has $1 lakh of bank lines of credit and a $5 lakh of mortgage on its property. Okay, the shareholders of the company have invested $1.2 million. Here's how you can calculate the debt to equity ratio. So we have all the information related to our formula. So like here $1 lakh of bank lines of credit and $5 lakh mortgage. So if you talk about total liabilities, we have $1 lakh of bank lines of credit and we have $5 lakh of mortgage on property. Okay. Then we have if you talk about total equity, we have shareholders of the company have invested 1.2 million. So we have $1.2 million of our equity. Okay. So we just simply put these values in our formula and easily calculate the debt to equity ratio. So in our case, it comes out to be 0.5. So basically what this 0.5 tells us that there are half as many liabilities than there is equity, okay, of a company. Like though each industry has different debt to equity ratio benchmarks, but as some industries tend to use more debt financing than others, so like a debt ratio of 0.5, it means that there are half as many liabilities than there is equity. Or you can say that the assets of the companies are funded 2 to 1 by investors to creditors. Okay. Now suppose like here the answer of debt to equity ratio comes out to be 1. So basically it means that the investors and creditors have an equal stake in the business assets. Okay, like if you talk about further related to this, like a lower debt to equity ratio usually implies a more financially stable business. Okay, because like companies with a higher debt to equity ratio are considered more riskier to creditors and investors than companies with a lower ratio. Because like debt financing also requires debt servicing or regular interest payments. So debt can be a far more expensive form of financing than if we compare to equity financing. Okay, so basically companies leveraging large amount of debt might not be able to make the payments. Okay, so companies with a higher debt to equity ratio are considered more risky to creditors and investors. Okay. And one more thing to add in this, like usually creditors view a higher debt to equity ratio as risky because like it shows that investors haven't funded the operations as much as creditors have. and investors don't have as much skin in the game as the creditors do. Basically, this could mean that investors don't want to fund the business operations because the company isn't performing well, or there are like lack of performance might also be the reason why the company is seeking out extra debt financing. So these all are the creditors view related to a higher debt to equity ratio. Okay, so this is the video for all of you guys. Hope you clearly understand about debt to equity ratio. If you like this video, thumbs up. Do subscribe to our channel Knowledge Topper, as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So this is the video for all of you guys. Thank you so much everyone. It's time to say bye bye.